Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. 3M announced earnings before the market opened on Tuesday, and there was really something for everybody in this report. If you were just looking for earnings per share, guidance for cash flow, well, they increased some of those numbers for this year, so that looks really positive. But long term, if you're looking at the company's sales trajectory and revenue growth, it was just a terrible quarter. So the market reacted positively. The stock was up about 5% in trading today. But I want to get into the numbers and detail some of the challenges that I continue to see for 3M. This is a company that has just been deteriorating over the course of the last decade. And I think we're seeing signs that that deterioration is continuing. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to thank this video's sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And let's just start with the earnings release because this will give a good grounding to the results. You can see that net income was down to $8.3 billion for the quarter. That was in large part because of a settlement with the Combat Arms product. I'll talk about that here in just a little bit. So at least on a GAAP basis, there was a loss of $2.1 billion for the quarter and now $7.9 billion. There's a lot of legal expenses, settlements that the company has been making in 2023. So that's a reason for the big losses. Loss per share is now $3.74 for the quarter and $14.34 for the year. Here's a little bit of information about that legal settlement with Combat Arms resulting in a pre-tax charge of $4.2 billion, impacting earnings per share by $5.80. So just a huge loss related to that. But that's not what I want to focus on here today. I want to focus on the trends of the operating business. This is a chart that 3M has been showing for a while. This is adjusted operating margins and adjusted earnings per share. Operating margins have been trending lower for 3M for quite a while now. And so what they're trying to show here is that, hey, margins are on the recovery. 21.6% a year ago and now 23.2%. So a big increase, but why did they increase? This is really the only number to be positive about, and that is what they call organic growth, productivity, and other. Organic growth is basically just increases in sale prices because 3M said that there was a reduction in volume, so they had increased prices, and then their restructuring means that they were lowering costs. So basically they're laying off workers. So that's how you get the increase in margin is you have less people working for your company, developing new products, doing R&D. So you're investing less in the future, but it makes your numbers look better right now. Also increase prices. The downside is you have lower volume. So that, again, there's a balance. What 3M has chosen to do is say, hey, we want to have higher margins, but they're giving up volume to get there. So something the market seems to be happy about now, but long-term may not pay off. They also talked about higher free cash flow, $1.9 billion, up 39% from a year ago. But how do you get higher free cash flow? Well, you invest less in the business. Adjusted capital expenditures were down 6% year over year. And I mentioned some of those lowered costs earlier. So that's the context with which I read all of these. You want to have a company like 3M be a growth company, but the actions they're taking to increase margins and increase cash flow is the opposite of what a growth company would be doing. And you see that in the results here. Safety and industrials. What's the number that pops out? Organic growth, negative 4.8%. Now, there was an impact from disposable respirator decline. Remember, respirators were one of those things that sold really well during the pandemic, and then the exit of Russia in 2022. But even without that, you would have negative organic growth for the safety and industrial business. Transportation and electronics, you see the same thing. Adjusted organic growth, negative 1.8%. What is the headwind here? You're seeing a decline in electronics, commercial solutions, and transportation safety. And that is not offset by some growth in automotive and aerospace. So you add all this together and you have, again, a declining business. Consumer, this is the thing that 3M has been known for decades. Products like Post-it notes and Scotch tape. Organic growth, negative 7.2%. And operating margins, just 20.5%. Really, really poor results. There were declines in home improvement, home health, auto care, stationery and office, back to school trends. just really no good news out of the consumer business. The one positive was healthcare. And again, this is something that just continues to grow almost like clockwork, but 3M only grew 2.4%. So a lot of healthcare companies growing at a better clip than that, but that's what we get from 3M is a pretty slow growth healthcare company. And that's really the only positive for the business. Now, this is the positive that I was talking about earlier. They raised full year guidance. So adjusted earnings per share, remember that pulls out a lot of those settlements I talked about earlier, up to $8.95 to $9.15 per share from a prior range of $8.60 to $9.10. And then they're also raising the adjusted free cash flow conversion, so the percentage of net income that is generated in that turns into actual free cash flow, from 99 to 100% to 100 to 110%. But what's the downside? Well, they're expecting less organic sales growth. So better cash conversion because they're spending less money on capital expenditures, on operating expenses, R&D. They're generating more cash because of those lower costs. So pulling in money now, and I think at the expense of investment in the future. 3M is really facing a catch-22. What do you do if you're in a business that's really in a structural decline? You have seen margins decline over a very long period of time, both gross margins and operating margins. Revenue has not grown. They've decided to spin off some businesses to try to extract some value there. But this is fundamentally not a growth business anymore. So you can either decide to generate as much cash flow as you can now by cutting expenses, or you can invest in the future in things like R&D and try to drum up more growth, more organic sales growth by developing those new products like Post-it notes, like Scotch tape, Scotch Guard, brightness enhancement film. These are the products that drove growth for 3M for decades. And what I think we're seeing right now is management just doesn't have the ability, the incentive, or the know-how to invest in those kind of products. And so they're doing what they can by cutting their way to better and better cash flow. That is something that's going to work short term. But I think for long-term investors, what you're going to continue to see is the deterioration in the business. Revenue is not going to grow if you're not coming out with new and innovative products. Margins are not going to expand when you're just competing based on a commodity basis with other products, especially when you're typically not the lowest cost manufacturer. So 3M is a company that's in decline, and I don't see that decline ending despite the fact that the market was pretty happy with results today. What I see is a company that has negative organic sales growth, and that is not a trend that you want to have, especially when the economy is growing. If we were in a recession, that might be a different story, but the economy is actually doing relatively well. So 3M should be doing relatively well, and that's not what we're seeing in these results. So that's my takeaway. But let me know your thoughts in the comments section below. Given how big this company is and how many tentacles they have in the economy, there's a lot of different things that you may take away. So love to hear what you're thinking. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.